China's economy has grown steadily over the past 40 years, becoming the second largest in the world. During this time, more than 800 million people moved out from poverty. However, this long period of growth may be slowing down as the capital that helped China's expand is decreasing. Energy prices are rising and the property market has weakened. The country now faces some of its biggest challenges in decades. Since China is an important trade partner for over 120 nations, any slowdown could affect many countries around the world. This video will look at China's debt problem, the difficult energy situation, and the possible action the government may take to keep the economy stable. China's modern growth began in the 1970s when Deng Xiaoping started series of economic reforms. This was a big change from the old planned economy. He allowed free market activity in four special economic zones to attract private business, foreign investors, and international trade. In the early 1980s, these areas grew quickly because of their success. As China joined the global economy and followed by WTO rules, foreign investments increased sharply. By 2008, they were over $100 billion. This led to an investment-focused growth model. Many projects were built and overinvestment created risks in the housing market. The government encouraged large infrastructure projects, new cities, and export industries. China became the world's largest buyer of crude oil, and fossil fuels now make up most of its energy use. As the biggest energy consumer, China must balance export, global energy prices, and borrowing for new projects. At first, having some debt for growth was normal, but now too many homes have been built, enough for billions of people. Many buildings remain empty, and some projects are delayed for decades. Real estate now represents almost 60% of family wealth and plays a large part in the economy. However, this strong focus on housing has created a big financial challenge. Falling property prices hurt both families and developers. Fewer people want to buy homes, and banks are stricter with loans. The government has reduced interest rates, but demand for new credit is still low. The property market is mostly contained within China, but other nations connected to Chinese investment like Australia, Brazil, and countries in the Belt and Road Initiative could also feel the effects. Some expect that China's central bank will add more funds to the economy to support growth. Still, the investment-based model seems to have reached its limits. The slowdown is influencing construction, steel, and cement industries. To protect long-term growth, the housing issue must be carefully managed. Inflation is another concern. Experts say that to keep the economy growing safely, China needs about 10% growth each year and around $5 trillion in new credit. This may increase production in export industries and the government supports. If China becomes a leader in electric vehicles, it could encourage more international car companies to produce locally. Many Chinese brands are already competing for its new market. Yet, the large number of subsidies and low-interest loans could create too much production of steel and cars. Even as people incomes grow, the economy still depends on export. China now sells over 5 million cars and 40 million tons of steel every year. Countries like United States, India, and Brazil are placing tariffs on some imports, so Chinese planners focus on key areas such as steel, chemicals, and farming, which are important for national stability. It is difficult to know when the China economy might face a downturn because the country closely manages information. The government has limited access to some economic data, such as banking and trade figures. If the economy were performing strongly, officials would likely share more details to show progress. For 2024, China's leadership set a goal of 5% GDP growth and 3% inflation. The plan includes careful financial support, not large stimulus spending, to reach these goals. China will need huge amount of energy, and domestic oil fields are producing less, and the country now imports around 70% of its oil, mostly from Russia, Saudi Arabia, Iraq, and Angola. This dependence makes China sensitive to global energy prices and political events. Rising oil costs could increase production expenses and slow economic growth. As global tensions continue, China is working to secure energy suppliers and protect financial stability. State banks such as the Industrial and Commercial Bank of China and the Agricultural Bank of China hold large amounts of real estate loans. If the property market weakens, they may face pressure. Shadow banking has also played a role by offering riskier financing. This makes the financial system more complex and harder to control. To manage these challenges, China may use its currency policy and continue adjusting trade and investment plans. The coming years will show whether the country can keep steady growth while solving these major issues.